All right, well, we finished the week on a little, our smallest move that we've had in the last few weeks. Right, we kind of finally had a quiet day, relatively speaking, filling in the gap that we have from the morning, and then closing. I think a lot of people are expecting Monday to be a down day, as it has been for the last few weeks, really significant down days. So a little selling going into the weekend because of that. So I'm going to break down this widely expected view, including what we've been talking about here in our videos for the last week, of what's going to happen next week. And this idea that maybe we might not do exactly what people think in the way that they think it will happen. So I'm going to break this up. That's a common technical outlook. It's when the bandwagon gets crowded, it's a lot of times the bandwagon never gets where it's going. The bandwagon usually gets where it's going with the fewest passengers, not with the most. So I'm going to break that down, what that means in today's video, and why we might not do what we expect, at least early next week. What signs are out there for that? We're going to talk about what's driving this price action, what drove this bullish week that we've had, what that means in terms of our expectations, and then our trade idea is we're going to look at a really juicy bearish setup to take advantage of, again, what most people expect to be, a downside move in the short term. So let's go ahead and get started. Today is Friday, March the 27th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we got light green shading. So we talked about on Monday, the idea that we typically don't have long periods of dark pink shading. This was a pretty long one by then. We were looking for that historic move sometime this week, potentially. That all-time historic up move. And we got that on Tuesday, the number 9th, the ninth biggest move higher we've had all time. Percentage-wise in the S&P 500. And that still didn't even get us to light green shading. We didn't get the light green shading finally until today. Light green shading, again, is when the intermediate line comes up. The intermediate line doesn't stay below the 20th percentile nearly as much as it stays above it. You can see when you get the near-term line pulling down below 50, it doesn't always give you light pink shading, but when it gets above 50, it typically does give you light green shading. So that's why you get a lot of brief dark light green shadings, frequent interruptions of the dark pink with light green. And so, but you notice the light greens don't last very long either. And that was a pretty decent one there that lasted a little bit of time on this particular pullback. If I were to go back to, again, 2008, our very custom or common time frame that we like to compare ourselves to here, in terms of how that created, you see that there's this light, the near-term rally did not produce light green shading, but this one did. And then you can see the next near-term rally that lasted quite a bit of time here that got you to the 30-day moving average with that big run higher on October 28th. That was one of the top 10 moves that we had in the last 30 years. 20 years. In the last 20 years. And then you can see a brief little near-term peak that did not produce light green shading, so a big band of light or dark pink, and then over here you got a lot of light pink, and then a big band of dark pink, and then that was it. At that point in time, that was it. We took off from there. So going back to the current level, we are light pink, light green. I don't expect this to be light green for very long. I mean, that everybody in the world is talking about the fact that we'll retest down to these lows now that we got that light green shading. Just keep in mind that might not be the case. If everybody's expecting something, it's not always, a possibility. Even though that's a pretty bearish candlestick pattern as a Harami pattern. That's about as bearish of a Harami as you could possibly get. Big, open, big candle where the whole range of the day was the body, and then a pretty wide inside day in terms of the range, completely inside of yesterday's range. So the high and the low are both inside of yesterday's high and the low, and then a really small body. So that fits right in the middle. So that's that's like a picture perfect Harami pattern that you would expect to lead to some downside movement. You notice we finished the week right at the 38% retracement level of this drop from the last light green shading. Same thing on the Russell 2000. We finished pretty much right, a little bit below the 38% level. It hasn't got the light green shading yet. That's a big band of dark pink shading. Again, another one reason why we might be light green for a little bit of time here. Not for very long, right? You know, not a big period of time. You can see the momentum line's already fallen down to the lower reversal zone. So we might, there's other reasons too that you'll see later, but we might bounce up a little bit more, you know, potentially up to towards this 2800 level as we approach that 30-day, that falling 30-day moving average within the next couple of days. So that's a low probability. You know, the high probability is what everybody's talking about. Well, we're going to retest these lows. Everybody's talking about that. I've been talking about it. Everybody's, you know, there's a big bandwagon right now for retesting the lows. So, you know, a lot of times when the bandwagon gets pretty crowded, then what the bandwagon's looking for usually doesn't show up as you think it will. And so, now it doesn't mean it won't happen. Nothing's ever 100% or 0%, right? So there's a good chance. I mean, that's obviously the high probability trade. But keep in mind that lower probability where, you know, we knock a few people off that bandwagon as we rally up towards 2800 first before we get that retest, and you know, which will, you know, cause some pain for people that are getting bearish right now. And we're making a bearish trade today, and the bearish trade we already made today actually in our live Market Outlook live videos already like doing really well. In fact, we've almost made as much money as what we risked on the trade today, just in the last 15-20 minutes of the market trading. So, you know, we put on the bearish trade, and a lot of people will. But if it goes up to towards 2800, I'm definitely not going to hurt us very much, you know, on these, because again, you know, we've got time on these trades, so a few days of movement against us isn't going to kill us. But that might, you know, get some people who might be over leveraging a little bit on this retest that's so popular, and then we'll have more of a retest to the downside that will cause some pain for people too. So we'll see if that ends up happening. You know, again, we can do that and still stay within kind of some retracement levels, not really be trend changing because we move so far away from that. It's rare for us to do that on this first move up. It's more common for us to hit resistance in this shorter area, but you know, again, we'll see. You know, back then when we hit these levels, we usually have a lot of people that are just doom and gloom, you know, or thinking that we're going to rally now. And then we cause them pain by coming down to the downside. All right, before we look at some other charts really quickly, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below this video if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us two things. Number one, it tells us you liked our video. Number two, it tells us you want us to do it again on Monday. If you don't like our videos, if you don't want us to do these anymore, you can tell us by not clicking on anything down there. If it's the other way around, you can just easily click that. You can do that right now while you're watching. It's a big deal to us. It's our survey that we look to see what you're thinking about our videos. Also, while you're down there, comment. What did you get out of our videos today? Love to see what your thoughts are there. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. I've been putting out a lot of stuff here this week, so make sure that you follow me there. And then join our Market Outlook Facebook group that we've created. All right, if you're watching us on YouTube, I invite you to check out some of the other things that are on this page, including our Market Outlook Live. I mentioned I already put on today's trade before the market closed, and it's already doing really well for us. Well, I do that in these videos. And we also review all the past trades. We manage them all the way up to the close because it's really important from an educational standpoint, and that not only do you get an idea from us on what to do as an example, but we follow through with that example all the way to the end. So we do that in these trade review videos. Again, you get access to that as well as all of our trading rooms with our monthly subscription. There's more information on that up here. You can see, if you click on the word pricing here, you can see the difference between these two plans and what each one of them offer side by side. The Q&A session is actually for our premium subscribers. I have that coming up tomorrow morning. Here's our classes we have coming up next week, some of them. We also invite you to engage with us on social media. Hit this little heart right there. that opens up a new window. You can click on this like button. Same thing with Facebook, hit that thumbs up. Again, we push this all the time because the more you engage with us on these platforms, the more they will promote our content to you. They promote content that you follow from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here, so that way you can always see our stuff. All right, if you look at the weekly chart here with the Hakinyashi candles, here's a really, really good sign. It doesn't mean that we're over, right? But it's a really good sign that we stop closing on a Hakinyashi basis below the prior week's low point. So once you stop closing below the prior week's low, then we might hammer out for a round for a little bit within the range, but at least the selling pressure is done. And so, the more you close below those lows, like the week before, that's significant. The last 2 weeks we've closed below, and sometimes you get about 2 or 3 of those. Most of the time just one, if that, right? You can see over here, this was really the only one, and that was it. We were done with the selling, a couple more weeks, and we had turning around. So, here we had 2, and now we're done. But these are still really big candles, so expect the candles to kind of start shrinking here. In fact, if you notice, next week's candle is going to be a lot smaller. If you look, if we kind of gauge what the open between the open and the close, the midpoint is what the next week's open will be. The midpoint between the midpoint, here we go, 25.40 is where we're going to open up. So right about where my cursor is where we're going to open up next week. And if you look at the top, look at where we're trading right now. We're currently trading at 25.41.47. So we're going to be trading right where next week's open is going to be. So what does that mean? Well, depending upon what kind of range we have, because again, the low of the candle, the Hakinyashi, is the actual low point for the week. So if we come back down here and form a, and retest these lows and have a pretty decent low to the downside, then we can, we can form another one of these types of candles and maybe take a few more weeks. But, if we kind of rally up first and then go down and end up with a really small body kind of in the middle here of this, with the up and a down move, then that very well could be our turnaround point. It's crazy to think that it could end up being next week, but most likely it's not, right? That's the lower probability scenario, but it's just if we don't retest these lows next week, as everybody's expecting that we will, and we end up kind of going up first and then coming back down, then we get that kind of a candle that generally leads to a reversal type move. So that's definitely something that we want to kind of keep our eyes on in terms of our expectations in the next couple of weeks. Let's take a look at the 3 green arrow chart. The nice thing about the 3 green arrows, you can see we obviously got 2 green arrows. You can see the volume, today's volume on the S&P on SPY was the lowest volume of the week, and it was also a small trading range, really, really small trading range, way below the average. Like, we haven't had a trading range less than 10 points in a long, long time. So very, very nice, especially whenever there wasn't very much of a gap here. We closed at 261.20 and the high was at 268.81. So, we were, if you include the gap, we were just barely above 10. So really, really small trading range, small volume. The volume was below average. This is the first day of below average trading volume that we've had in a long, long time. 224 million. So that's a good sign. With these 2 green arrows, almost, not quite 3. When we get these kind of 2, 3 green arrow patterns, those can be pretty bearish patterns here. I'll show you the 2-line versions, and you can see we're trading right up to that 17. In fact, today's range stayed between the 8 and the 17. That's why I say, there's a chance that we might pop up here first. Because we held the 8-day, we didn't come right back down below the 8-day after failing at the 17-day. So we kind of held that first. So if we do pop up, I think it's very temporary. But I think it's just the purpose is just gonna be to get rid of all these expectations. Get rid of people off the bandwagon, off the retesting the lows bandwagon. Get them thinking, may get more people thinking this might be a V bottom. We might not retest those lows. Then that's when we'll probably retest the lows. at that point. So we'll kind of keep a ride. The MACD is the histogram's positive, which means that we're above zero, but the 8 and 17 day are way below the 30s. So we're not going to be reversing here anytime soon. The stochastics is rising, but easily in the lower half of its chart. All right, we take a look at that volume. Well, let's take a look at the 4-week range first, and we got up close again. We filled in this morning's gap. I taught today in my technical analysis class about what I look for at the beginning of the day. So in terms of these gaps, and the expectation here was most likely that's a common gap. We weren't breaking through any levels. We didn't have significant volume. We're not running away here to a new move. We haven't had a big move here. This is more of a runaway gap than that one is. So more than likely that was a common gap that was expected to be filled, and then again, at the beginning of the day when we're down that much and we kind of hold there, good chance that would end up being the low of the day. So considering the expectations for gaps to be filled, so you notice again why it's not going to be too easy to drop, because we got some volume now below us. In fact, we got the point of control for the last 4 weeks currently below us as we pull back down at the very end of the day here. And there's still a vacuum of volume. So, again, that bandwagon's pretty full to come back down to 220. It's a pretty full bandwagon, and we might suck up through that little vacuum of volume up towards that node or the top of the value area. By then, the moving average 30-day will be down there. By the time it'll probably take a day or two to do that. If we did that, that's going to kick more people off the bandwagon. People will be suckered off of that. But it will also just be a reminder that as fast as we went down here the first go around, we won't go down that fast the second go around, because we'll have a lot of support below you now. So it'll be harder to break through. It doesn't mean that we can't go through. It'll just be slower. And that's what we see all the time. We see when the retests are always a lot slower than the actual first thrust of selling that we typically see. So I mentioned the volume. Let's go back to the volume here just really quickly. It was 224 million, and the trading range was under 10 points, right? So let's take a look at that on a relative basis. So 10 points is way down here on the ATR, so that's a good sign from a bullish perspective. The volume was at 224 million. That's way down here. That's a good sign from an average perspective, average volume perspective. So when these lines fall down, that's good. And there's a lot of room to fall down. Now, granted, you remember in 2008, 2009, and other times, this ATR to price ratio was way down. In fact, I already showed you the 2008 period before in prior videos, I believe. But if we were to take a look at 1987, where we didn't go to a lower low, right? We kind of held up. Here, let's go to SPY, and we won't have the volume here. But you can see by the time we formed the low point, which is more over in this area, the ATR on a relative basis after spiking, I want to say spiking and peaking at the same time. After peaking way up here at these high levels, by the time we formed the low point, which is way over in this area, I mean, this is it was actually a little bit longer. I have to go out to let's go out to June of 1988. By the time we formed the low point, and really got going to the upside, the ATR had fallen way down, right? So in all these retests, the ATR was way, way, way down by the time, was back down towards 2% by the time we really got going to the upside. So, when you look at it on that level, we're not, even though we didn't go any lower, and we might not go any lower than this go around, before we find that's most likely not the low point until we get more of a decline, which means we're going to get smaller moves to the downside, smaller moves to the upside. We've seen that already start to show up on this. We had such extreme moves on this chart, both to the downside, to the upside. Well, now we're going to start getting smaller moves, 3%, 2% or less, and same thing on the upside. That's a good sign for the market. That means that we formed that the peak of the selling is over with, right? Doesn't mean that this is the low point. We might go lower than that, but the peak, the pressure, the quick fall off a cliff type moves, they're done. We're done with those now. you can see even the implied volatility is a lot lower than the historical volatility is. Now, usually that means we'll have a jump up in volatility to catch up to it, right? Usually we kind of, when we pull that far away, we jump up, and usually they go down together. Right, if I go back to 2008, I showed you this I think already too, but if I go back over here to 2008, we dropped down, and when the implied volatility dropped down, we went up to it. We pulled away from it again, we went up to it, and usually they both go down together, and then we really set that low point by the time the historical falls below, because more often than not, the historical should be below the implied. There should be more volatility expected in the future, in the unknown, than what we've seen in the past. That's usually the case in the known. And so but they'll come down together when that happens, and obviously we're not in that mode right now. So we'll get some ups and downs here still, and retests and some jumps in volatility. In fact, when you look at the volatility, another reason why I don't think it might not be Monday and Tuesday is because look how high volatility still is. So on a relative basis, it's still really high around this 120% mark, which means that while it's down from 85, it's still really high relative to the 3-month volatility, VIX 3M. Right, this is dropped down more. So which means now we're not so bearish like we're not so elevated. With the VIX is elevated, we're not still really elevated in that back month. We're starting to calm things down, and we're looking at more volatility in the very short term than in the longer term, and that's a good sign. That's a good sign that we're up to that high level, because as that falls, as we fall back towards 1, typically the VIX falls a little bit with it, right? I don't think it's going to fall all the way back down to 30 here, but it could very well fall back down to 50-ish in that area as this falls back, and if it does that, that typically aligns with a jump, jump up. So another sign that we might need, that bandwagon might not be headed towards that retest quite yet. It's loading up. A lot of people are expecting it, but we might not be headed there right off the bat here before we, like I say, kick a few people off first. All right, so before we look at some other charts and talk about what's driving this action today, just a quick little pause and just summarize our technical outlook. So we got the bounce from extreme lows. We were looking for that at the beginning of the week into last weekend. We got it. We got the light green shading in the market forecast. Now it's a question of how and when are we going to retest these lows. That's the big expectation. A lot of people are looking for it. The high probability is that we'll do it immediately starting early next week. But there's a lot of people looking for that, and because of that, don't be surprised if we don't bounce up a little bit more in the next couple of days, Monday and Tuesday. Typically, Mondays have been bad days, for the markets. The markets tend to be pretty bearish. And Tuesdays have been really bullish. So, maybe it's going to be the other way around next week. Maybe we go up first on Monday, kind of throw people off before we come back on Tuesday. Because, again, a lot of people are expecting these patterns. And when more and more people expect the same pattern, it doesn't always show up because of those expectations. And we probably saw a little bit of that today, at the very end of the day, when the market sold off really hard at the very, very end, because a lot of people are probably expecting Monday to be a down day. So they're getting ahead of it with the selling, and that might not produce the same pattern because of it. So what do you think? Do you agree with that technical assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that suggests either you're a lot more bullish or a lot more bearish, and share that those charts or indicators or whatever it is that you're looking at with our community down below. All right, let's take a look at the week that was. And you can see that, this week, real estate, preferred stocks, they actually rallied too, coming off of the 2009 low point really hard. So it's actually a pretty decent sign that those two are rallying. We've seen that before. Small cap stocks kind of matching for the most part of the week what was going on. Emerging markets lagging. They lagged developed markets most of the week. In fact, you can see, not surprising to see long-term bonds underperform, but it is a little surprising to see gold outperform, like emerging market stocks. So high yield also bounced up, have been very oversold. And this is also the other thing about crude oil. Now, crude oil, I did tweet this out. Again, make sure that you follow me on Twitter here for more. See, where are we? For more content I put out there. I talked about how crude oil has been underperforming, lagging this week. There's been a lot of people saying, "Oh, well, crude oil, we can't be bullish if crude oil is not rallying with us." Well, I tweeted this out. If you notice, I said when you hear talking heads talking about oil not moving and that being a concern, this is that move off of that 2009 low point, the March 2009 low point. Again, you notice real estate and preferred stocks led the way higher, not surprising. You can also see emerging markets, small caps did okay. But look at crude oil. In fact, at this point right here in mid-April, so a month and a half into off of the low, you can see that stocks were up 20+% off of those lows, and crude oil at that point was down. And that was with a weak dollar. So it wasn't really the dollar that was pushing it down. So crude oil is a lagging asset class, and that's kind of what I shared in these charts here. This is the chart, coming into the crude oil peak. This is what I think is actually the start of the bear market that we've been in. I think we're finishing a bear market. I think it started back here in January of 2018. I've been telling you guys that for a long time. I think that's where the bear market started. And you see how at the end, after we had the peak in equities and we had a little bit of a higher high in small caps or in large caps there, look at the peak in crude oil coming way after. Big surge in commodity prices. It's a lagging asset class. Look at it coming off of that low point. It's a lagging asset class. Crude oil will lag behind. It peaks later. It turns up last. It turns over last. And it turns up last. So if it doesn't rally with equities, don't be surprised, right? It takes a while for stocks will price in the expectations that the economy will improve, right? So they'll do that before the economy improves. Commodities will start to rise as it's being used, as there's demand for it. And right now, there's not a lot of demand for commodity prices. Not expected to be a lot of demand for commodity prices. So, keep that in mind. Don't get wrapped up with crude oil lagging behind. It is interesting and a good sign to see the dollar. Now, the dollar, that's a lot of volatility for the dollar. But it is a good sign to see the dollar rolling over to the downside. Markets will be more bullish when the dollar rolls over. And we don't have the dark pink shading in the red line, but we do have a red line. It was that hard of a fall for the dollar here this week. Very, very good sign. In fact, if you look at the euro US dollar, the biggest currency, most liquid currency pair out there, you can see it's almost a dollar in reverse, that dollar index in reverse. Very good sign for the euro. So from a long-term perspective for the euro, which gives us the implications of where the dollar's headed. You can see we've been on this bearish trend, but look at that candle. We had broken out. That was a big breakout on the euro a couple of weeks ago. Again, very bearish for the dollar, very good for the markets, but the markets weren't bullish then, so we had a couple breakdowns in the euro. Really, really, big volatility moves. Well, now that's just like that. In 1 week, we went from being way down the 200-day moving average to right back up above it. So now if we'll hold that, great. If we hold that break above, then there's a good chance we can get a golden cross. And remember, the dollar, the S&P 500 always does better in these golden cross environments. The market bottomed out here in early 2003, and we rallied into this September high point. The stock market peaked here in 2007. We tend to do better when the dollar falls, and so as we get some dark green shading on this chart, that much better for the market as a whole. But again, if crude oil doesn't rally because it's so far down below the 200-day moving average, to the point where it's actually giving us a cluster on the weekly charts. If you look at the market forecast here for crude oil, you can see it's actually got a cluster and a very small range this week for crude. Very, very small range. So a very good sign that we might be rolling back up here. Again, there's also a lot of talk about the demise of crude and how it could go to single digits. And the more talk there is like that, the more crazy predictions there are out there like that, that's usually a reversal sign, whether it's up or down. In this case, it would be down. So the more crazy prognostications that there are, the more likely that, we're hitting a low point. Just like, if we're up at the high and market's saying, hey, we're going to get to $200 crude. Well, that's a pretty good sign the crude oil is peaking. And we're starting to see a lot of those, and we're starting to get these clusters, and that's a good sign. That's a good oversold sign, and from a risk appetite standpoint. And if we get a bullish bounce in crude oil, remember, this is typically a lagging asset class. So if this rallies pretty decently next week and kind of gives you a little morning star candlestick pattern, then we might end up having another really good week on stocks next week. I wouldn't expect the same kind of week we had this week from a size standpoint, percentage standpoint, but if we don't retest the lows next week, I think that's going to surprise a lot of people. Let's take a look at how the sectors are performing here. Let's actually take a look at the 12 grid. We haven't looked at those for a while. Take a look at the 12 grid for all the different sectors. A lot of light green shading, right? You can see that in the S&P 500. You can see it over here. Lots of light green shading, lots of red lines. We don't have, again, dark green shading and dark green lines. When you get that combination, that's a really bullish, that's the beginning of the bullish trend. So, but it is good to see lots of high 20s, mid to high 20s on all of these. The only ones that aren't still are the financial sector and the energy sector, still kind of lagging behind here and struggling a little bit. Now let's take a look at the sector comparison. Again, just for this week we'll come over here and take a look at it for just this week. And you can see, by the end of the week, we had real estate, we had industrials, again, these airlines and Boeing, utilities and real estate. That's not your typical bullish sector. That's not what you typically want to have lead the way higher. Energy was up there until it kind of peaked and then fell down these last couple of days, and materials also struggling, even with the rise in the dollar. So, you don't want energy, you don't want industrials, you don't want utilities and real estate especially to be the leaders to the upside. You want technology, you want cyclical. It's okay if industrials, but you don't want the airlines in the industrials area. You want, good manufacturing, pick up in manufacturing. You want to pick up in consumers. That's what you want to lead the way higher. And we don't have that yet. So we're not out of the woods yet. This isn't your bounce up higher. Again, if I were to go back, to that 309 of 09, and then just go for a month, the next month higher. And I won't be able to do an intraday chart, but to kind of give you an idea of these sectors and how they performed right off the bat. Of course, the financial sector was the most beaten up. It rallied higher, but there's your discretionary and industrials and materials. Manufacturing picking up and consumers picking up. Technology right behind. Your safe haven sectors lagging. And that's what you would expect. That's what you would want to see, and that's what you would expect from the market. And so that's what we would look for once we really know that this bounce is occurring, right? That we formed the low point. When you start forming, a low point, when we don't peak yet, we just kind of run up towards that 50-day moving average, or we run up towards the 200-day moving average. Usually a lot of those bear market, quote-unquote bear market rallies are led higher by these safety areas. People are going into spots where they feel safer on any subsequent downside move from there. So that's kind of what we're still seeing here. We might still run up a little tomorrow on the Tuesday in the short term. Don't get suckered into thinking that, okay, now we have formed the low point, right? That's the point. The point is to sucker people in and produce the most pain. So just recognize the fact that if we do rally, if we don't do what everybody's expecting us to do right off the bat next week, that's okay, right? Eventually, we probably will retest these lows, just not in the exact way that everybody's expecting. All right, as I mentioned, we've already placed today's trade idea in during our Market Outlook live session. Again, all of our subscribers, monthly and premium, get access to that video. It's 3:30 Eastern time every day that I do the Market Outlook. So Mondays, Wednesdays, and Fridays. We review all of our old trades and we put on today's trade. The trade that we did today, just to kind of give you an idea of what it looked like right before the market closed, we looked at Oracle. We placed that trade here right as it was falling from these levels. and it started to fall down. So that's the move it made afterwards. And like I said, that drop has already given us a pretty decent return on the trade that we're looking at. There's a few things that kind of stood out to me. If you take a look at its market forecast, here, let's look at it on this chart here. First of all, it's stochastics. You know, we really bounced up. We got a long upper shadow with that drop that we had. Really high stochastics I don't expect to hold, right, because we're in this bearish trend. So that's the scan that kind of stood out to me. Let's take a look at its market forecast pattern. And you can see that we got light green shading in the yellow line. That is about as bearish of a pattern as you could possibly get. It really tempting bearish pattern from a directional standpoint. You can also see too, again, when you get 3 green arrows, it's typically a bullish sign, or 3 red arrows, typically a bullish sign on upward trends. Well, on downward trends, if you get 3 green arrows, it's typically a bearish sign. And you can see the volume kind of picking down there. If you look at the long-term moving averages for Oracle, you can see we pulled right up to that 50-day moving average. Remember how I said that's usually where we'll either get above it and then stay above it and fill in the gap between the 2 lines, or we'll hit it and retest these lows. So there's a good chance of that happening. And one of the reasons why is if you look at its Bollinger Bands, on an intraday basis today, we got all the way up to the value area. There's a big resistance above us here. It's going to be really hard to get going and really easy to go down because there's hardly any volume below us here on the 1-year chart. Even if I were to go out to like a 2-year chart, now you can see there's a little bit of volume here because of all this from previously in 2019. We were in this area. But if you break down below here, you can see, you know, that's getting through this level 45, even just getting to the bottom of 45. That's actually where our short strike price is for our trade. That would be ideal. The other thing that kind of stood out to me, whoops, not the DMI, it was well, let's take a look at the DMI. The other thing that stood out to me on the DMI was the positive directional index crossed above the negative, but it did it with both lines below 20. So very negative. I mean, that's a bullish crossover, but it's a very bearish bullish crossover, one that you can sell essentially. And then the Ichimoku cloud was the one I wanted to take a look at here, and you can see the Ichimoku cloud again. We got above the blue line while still below the cloud. That's usually a bearish sign too. So again, lots of sell signals to be able to at least short or do a bearish trade on the stock. And so, and what we typically do when we do the bearish trades is we look at vertical spreads. So, or buying a put. In this case, I like to buy the put and then sell a put, and this is a $3 wide spread. So selling that put helps cover the cost. So there's the long put, and then you sell this, it covers the cost for it. We ended up getting in at 58 cents, so we're up 40 cents already on a relatively wide spread. And this is what its chart looks like. So we went with about here, let's get rid of the paper trade. We went with 3/4 of a normal risk. We don't have to worry about earnings, but it is rather speculative. So we went with 3/4 of a normal risk. We have a really good chance of keeping our risk smaller than even that because there's a big resistance above us, right? So if we were to break through, then we'll probably end up with half of that loss, and we'll take it. But to the downside, you can see that, again, just getting to 45 will give us a really good reward for the risk that we're taking in this trade. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It opens up the link to our Market Outlook forums. You can ask any questions or post any comments you have about today's video there. Reply to anybody else's comments to our threads, and let's keep this conversation going here over the weekend. Thanks again for watching our video today. Remember to hit that, subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Join our website at marketscholars.com. Follow me on Twitter for more content between the video, as well as join our Market Outlook Facebook group that we've created. Have a great rest of your weekend, everybody. Thanks for watching, and we'll see you all next time.